We have, I think we're continuing a conversation that's already underway based on the discussions yesterday and this morning. The subject that we're going to drill down into of foreign direct investment is one that is fairly politically topical at the moment, needless to say, in different ways, and likely to remain so for many years. So I want to introduce our panel. You know them. They come from different vantage points of this, and I hope we have a lively discussion. As in other such sessions, will also welcome questions from the room. So at some point, I'll offer it out to you, and we will keep that conversation going. So our panel today: Mark Wiseman, CEO of Canada Pension Plan Investment Board; Felix Chee is the Chief Representative in Canada of China Investment Corporation; Murray Edwards is Chair of the Board of Canadian Natural Resources Limited; the Honourable Jim Prentice is currently Senior Executive VP and Vice Chairman, CIBC; and the Honourable Tim Groser is the Minister of Trade from New Zealand. And I suppose I want to start with a kind of where we stand on the Canadian scene. Because for many Canadians, this sort of question of is FDI good or bad is very specific. It's case-specific. It comes up on big deals, big transactions like Potash or Nexen. And that may not be the best place to start. It becomes very emotional and becomes very political. So, Mark, I'm going to start with you. I'm going to ask everybody to just weigh in on this. How do you think Canada's doing relative to other nations, relative to our big trading partners, relative to history and our ambitions? Are we on the right track when it comes to welcoming foreign capital?
Well, I think we're on the right track. And you have to remember, for the Canada Pension Plan Investment Board, we're in a different position. We're an exporter of capital. And one thing that's, I think, important to understand is that Canada, proportionate to its size, is a very significant exporter of capital around the world. And so today the Canada Pension Plan Investment Board manages assets of about $166 billion, and 60% of those assets, and growing in percentage terms, are invested outside of this country. And so from our perspective, we have the perspective of being an exporter of capital and we have to be, because quite frankly the Canadian market isn't nearly large enough, nor would it be prudent for us to invest those funds solely in Canada. And so our perspective then becomes, well, what would we expect when doing business in other countries? And do unto others as one would expect one to be done unto themselves. And so I think our view is that actually Canada stacks up reasonably well compared to the experiences that we have investing around the world. But I would say, by and large, what we are seeing is what I refer to as an increasing degree, and it's a creeping issue, of what I refer to as capital protectionism. And we were talking about the last panel was talking about the WTO. There's nowhere really to go to in terms of complaining about capital protectionism, which comes in a lot of different forms. It comes in terms of foreign investment review. It comes in the guise of homeland security, if you want to talk about the CFIUS legislation in the United States. It comes in the form of foreign exchange restrictions. It comes in the form of tax rules. And I would say, particularly in the period of time leading up to and since the global financial crisis, we have seen an increasing amount of capital protectionism seeping in. And I think Canada has an opportunity to be an example, not naively in my view, but Canada has an opportunity to be an example in terms of fighting back and beating down the rise of capital protectionism.
Felix, what's your view of the Canadian landscape for FDI?
I think, the perspective would be it's still a very, in a relative sense, as Mark said, a receptive jurisdiction for direct investment. CIC has several investments in Canada. It's actually disproportionate from a geographical basis, and they've all, worked out reasonably well, and they've all been done with a minimum of, I don't know what the right word is, of fuss, I suppose. But it'd be interesting to see going forwards how something like the CNOC-Nexon deal would be dealt with. I think there are probably 1 million pairs of eyes in China looking at this thing. And
only 1 million?
Well, all right, 1 billion then. And when I've been asked about it, I said, I don't know whether the issues would be the same if it was Exxon Nexon. So I think we need to focus on. I don't think it's about foreign investments; it's about China. So I'll just park it there.
And I think we'll come back to that, Murray.
Yeah, I have a little bit of experience in this. In 2006, when there was much debate in Canada around the acquisition of Inco and Falconbridge, the government of Canada in early 2007 put together a panel under the Prime Minister and the Ministry of Industry, who ultimately became Mr. Prentice. And 5 of us, chaired by Red Wilson, Tom Jenkins of the Council, Isabel Hadon, Brian Levitt, and myself, over the period. It was one of the great bad deals I've ever negotiated. The Prime Minister, when he asked me to do it, he said, Murray, we want you to help us on a panel. It'll take about a day a month. And I said, okay. And he says, Murray, we'll pay you $500 a day. I said, I'll tell you what, I'll do it for $1 a year. And so we agreed to do it for $1 a year, the whole panel. And we ended up spending 2 to 3 days a week for an entire year. So the government is good at negotiating contracts, obviously.
We paid you.
You did pay us. I have to be honest, I didn't declare it in my tax returns. So, anyways, we over the process of from July of 2007 to June of 2008, we did a fairly broad consultation on the whole question of foreign investment, which was resulted in a paper we released in June of 2008 called Compete to Win. And in that, we looked at the whole question of foreign investment hollowing out. And the conclusion that the panel made clearly was that foreign investment is good for a country. You need foreign investment. It does make the country sharper. It's good for consumers in providing more competition. It's good for business, making business more competitive globally, and it's good for growing the economy. So that was the basic premise of the whole report. The report also had 65 recommendations to the government about things that we saw, though, if they're going to be able to compete to win on a global basis, in other words, Canada and Canadian companies, there are a number of things that we recommended the government have to do so that we can compete on a level playing field. Some of the things the government have done, some things they have not done. But out of that report, and I can talk a bit later, some of the conclusions we made, but the basic conclusion is foreign investment is good for the Canadian economy, and on the whole, when you looked at it, that Canada, both in terms of inward foreign investment and outward foreign investment, we're doing well. We are holding our own on a global basis.
Jim?
Well, I think it's fair to say in the globalized world that we live in, not only do companies compete, but countries compete. And so we're engaged in full-on competition for labor, for access to markets, and for capital. And I think that's been made very clear over the course of this conference. So in terms of how Canada measures up, I think we're well positioned, but I think we have to continue to respond to what I've sometimes called the Asian century that we're about to see, to make sure that in all of those respects we can compete, and in terms of foreign direct investment, that we can be the recipients of that capital. So I think it's important to point out that we have been very welcoming as a country of foreign direct investment. The history of Canada from the time of the fur trade really is a small population, an enormous landmass, and it's inconceivable that a country like ours, which is half of 1% of the world's population, with a disproportionate ownership of almost any commodity that matters, that we could develop out this country without foreign capital. And so I think we have a regime that welcomes foreign capital. We can come back to the CNOC-Nexon transaction. And in terms of Murray's comments, this happened relatively unnoticed, but the panel that Murray was a part of made some very good recommendations on how to improve the Investment Canada Act. With virtually no public controversy, about 50 of those recommendations were incorporated into legislation to improve the system and make it more amenable to receive foreign capital. And that all cleared the House of Commons in the 2008-2009 period. So, so I think we're well positioned, but we have to be vigilant.
Tim, I think you're the only member of this panel without direct skin in the game in Canada. So we welcome your view on where we stand.
Well, look, I can't comment on where Canada stands. I can only give you a picture of the same debate that's going on inside New Zealand, that's going on inside Canada. It may have some slightly different characteristics, but fundamentally it's very similar. So there's, first of all, a group of people who are ideologically opposed to foreign investment per se. And, I don't know how to reach those guys. National income accounting identities rule here. If you don't, save enough to balance your consumption and investment needs, you need somebody else's capital. And they would be if some idiotic future government were to stop foreign capital coming into New Zealand, those very people that are most opposed to foreign investment would be the first people to be out on the streets complaining about the unemployment it would create and the companies it would close down. So there's that level. Then there's specific sensitivities around certain issues. There's sensitivities around, it's particularly strongly in New Zealand, around purchase of land. There are some sensitivities around strategic assets. I'm well aware this is a big and interesting debate going on in this country now. So, I can elaborate on those themes, but I can't comment on the Canadian situation directly.
You can. You're among friends, but...
I've never believed for a minute in Chatham House rules.
I want to show you two slides that have to do with Canadians' public views of these things. The first one, I'll admit, surprised me a little bit, and it's a question of the number of Canadians that say we should be more open to foreign direct investment or foreign investment. And it's a nice majority. It's long after this slide. It's the fourth slide. But it's 59% of Canadians that either strongly agree or somewhat agree that we should be more open. Now, there's fully... there it is. It's the one with 48 as the biggest triangle and 11 as the smallest triangle. There's the one next to it. Should be slide 4. Anyway, 59% that either strongly agree, there it is, or somewhat agree, which is a nice, healthy number and not perhaps what you might guess. But now we go to the next slide, which is slide 5, and it's a question of whether you're more worried when it means we lose control of our natural resources. And then the majority say, yes, I am more worried about that. Is it different? If we take this out of the theoretical and we get to the specific, does it make a difference when it's a hard asset? It's not capital, it's not investment, it's not building out infrastructure, it's a hard asset that we can only sell once. Jim?
Well, clearly, I think if you look at the slides and analyze them, public opinion on foreign investment has always been somewhat fragile, and there is a good 60 to 70% of the Canadian public that consistently across all the polling for more than a decade has been concerned about investment, particularly in natural resources. The issue, I think, at the moment is very much focused on the oil sands, but it's an issue that can flare up in relation to potash or other resources. Paradoxically, Canada's position is strongest in terms of natural resources because it's not as though they can sort of be quickly removed. It has to be part of the Canadian economy if they're going to be exported. But to be clear, there is a sort of broad-based Canadian concern about that. And as Tim says, how you reach those people and assure them that these are investments that are to the net benefit of our country is an ongoing issue.
Mark, is there an argument to be made that it's a different category of asset?
Well, I think I agree with Jim. I think a couple points that are important. First of all, capital is required to exploit the assets. And the other thing that's interesting, and always has been, by the way, foreign capital in one form or another, going back since before Confederation, has been required to exploit our natural resources, and particularly, interestingly, in the Western Canadian Basin. And so that need for capital, you can't have your cake and eat it too, or have your oil sands, as the case may be, and eat it too. But this is, it is and we've learned this as an exporter of capital, and Tim will remember the story well. We tried to buy a certain airport, the CPPIB did, in Auckland, New Zealand, and it became the same issue. This was a publicly traded asset. This wasn't an asset that was government-owned. It had been long since privatized. And the argument was that it was a strategically important asset for New Zealanders, which it is, because it's the airport. You know, what were we going to do with it? Were we going to pick it up and move it to Vancouver?
That was our great fear, yeah.
So the point I would make, and again, it was the previous government in New Zealand that took a very different view to the current government. But these issues are fundamentally emotional. And I think one of the things that's really important is that we have to try, and because you're dealing with foreigners, whether it's Canadians being foreigners elsewhere or foreigners coming here, it's very easy to stir up the political debate. And I think what we need to do is be as dispassionate about it as we can, to be logical, and to really look at the facts and the potential costs and potential benefits to the country in the long term.
There's something slightly dismissive, though, on all of your parts about this persistent public view in multiple jurisdictions across the world. There must be a reason, and if it's emotional, it doesn't necessarily mean it's irrational, that citizens of countries feel as though there is some sovereignty issue around this. It also doesn't mean they're right, but we shouldn't dismiss it. The
sovereignty issue is between provinces, let alone between countries.
Sure. But in this case, Felix, you mentioned the China-specific. Let's talk China-specific, because it does become more complicated. India puts all kinds of controls on the ways that we can invest there and forces partnerships, and it is different because it's China, Felix. We have a very fragile relationship. China continues to change and evolve, but there are many things about the country that we don't understand, that aren't fully visible, and that we worry about.
Well, I think you have to kind of step back and look at some much more macro context here. This is a period going forward, and I kind of put a marker or timeline at 2008, which to me marks the end of what has been commonly referred to as the Great Moderation. And I call the period going forward the Great Adjustment. So you're seeing adjustments within countries, between countries. You're seeing adjustments at different dimensions, social, political, financial, economic, whatever. So we're going through this period where a lot of large adjustments are taking place. And so, as I said, I don't think there would be this much fuss if it was Exxon buying Nixon. But CNOOC buying Nixon is caught up in this macro of all these shifts that are taking place. And it's going to take time. It's going to take a constructive kind of an attitude to go through. Otherwise, we're just going to have, I suppose, some either relatively small or some relatively large accidents. But that's all part of reality. And so that's the context that I look at this and said, we'll muddle through this somehow. But it's not going to be linear. One thing that struck me listening to the last panel, and I suppose there was a theme coming through yesterday and today, is this discussion about a national strategy or about dealing with Asia. And I said, sounds like exactly what they're objecting to on the SOEs. So, I just found it ironic for this call for saying we need to have a cohesive strategy for dealing with Asia, and yet the perception about Asia having or China having a cohesive strategy in terms of investments is having that kind of negative perception.
Yeah. Jim, do you have a view of how this fits into a larger policy?
Well, let's just speak of a couple, I think, pretty clear and persistent themes through the last couple of days. And there is nothing more important in Canada right now than trade diversification. Clearly, with what is happening in Asia, focus on China, but not only China, India, Indonesia, and elsewhere also. We have to diversify our country into those markets as quickly as we possibly can. In that, Rubik's Cube. China is, I think, the most difficult part of the puzzle. But it's also the biggest market prize for us as Canadians. I think we have an incredibly strong position to do that. I think actually the Prime Minister deserves an enormous amount of credit because we have now got at least in concept, a strategic partnership with China by the declaration of the Chinese government and our government. It still needs to be fleshed out. We still need to negotiate agreements. But that's been a remarkable distance to come in only a few short years. I think where we are now as Canadians, especially as it relates to energy, we're very much at the center of the geopolitical chessboard. And I think we have to be very shrewd how we play our hand from here.
I think Mr. Desmarais said yesterday that the key to accessing foreign markets, and China in particular, is less by less trade agreements and more a whole bunch of other stuff about ease of doing business in those places. And so I guess one question I would have, and Murray, this may be a good one for you, certainly, Mark, is whether using the leverage we have over these kinds of transactions doesn't actually make it easier, smooth the path for Canadian business to get to those markets.
I think that we have to be careful. I'm not sure how much leverage we have in bilateral discussions or in terms of market access. I think our leverage more is that as a country, we sit in a unique position that we have a lot of what the world wants in terms of natural resources, agriculture, product. And we have to find what's the best way to ensure we have capital to develop that and maintain the quality standard of living that we have in Canada and respect for our rule of law and environmental standards. And I think that that is going to be the debate, the discussion that takes place over the next 6 months and beyond that as we bring more foreign investments into our resource sector. It's interesting, if you look on the TSX, something between 60 and 70% of the TSX is basically made up of financial institutions and the resource mining and oil and gas sector. We have really in Canada two sectors that are strong, our financial institutions and our resource sector. And the financial institutions, in our report, we did meet with 4 of the 5 bank CEOs. We did discussions with them, and in Canada we have a thing called the widely held rule, which basically says that no one individual can own more than 20% of the votes or 30% of the equity of a Canadian bank or insurance company with a market cap over $5 billion. And we asked the bank CEOs if that limitation had ever prevented them access to capital, whether it be foreign capital or otherwise. And in every case, they said it never had prevented them access to capital and their ability to grow. And we've had great success in the financial institutions. When you come to the resource sector, we don't have the same limitations, and we clearly need foreign capital in the resource sector. The question is it wide open, or will there have to be, is there in certain circumstances some limitations? I think we've already crossed that decision on the BHP potash decision. I think there was a strategic decision made by governments, both provincially in Saskatchewan and federally, that particular transaction, for certain reasons, was desirable to keep as a broadly held Canadian company. I think in that context, there was a lot to do with the strategic nature of the asset, the size of the asset. And so I think we're going to have that same debate, frankly, in the oil and gas sector, largely focused, I would argue, on the oil sands.
Yeah.
In the broad conventional side, we've had a number of investments by foreign entities, and our conventional business, there's 300 conventional companies. There's a new one started every week. There's all kinds of opportunities for capital and competition, and I think in the conventional side, foreign capital is encouraged and needed. On the oil sands, it's a bigger discussion, a bigger debate. One observation is that when we did our panel, we went down to Washington and met with the Department of Treasury under Hank Paulson at the time, and we sat down with them. We said to our American friends, we said, tell us about foreign investment. And the Treasury official said, foreign investment, we love foreign investment in the United States. We have no restrictions whatsoever. Anybody can invest whatever you want, however you want. Come on in. And so I sat there quietly, as I tend to do, and I said, but explain me this Dubai Ports thing or Chevron Unocal. And they said, oh, Mr. Edwards, we say no when we want to, we don't like you. So the message was, we're open, but. And I think that there's a lesson learned there for you as a country is when do you make those but decisions? When are the strategic decisions? And I think that is the debate discussion that's going to take place over the next number of years. I have some thoughts on it, but
May I mean, you said, you collectively sound dismissive of public
With respect.
concerns. Look, we cannot afford to be dismissive of public concerns. I mean, we are insider opinion here around this room, and betray public opinion at your peril. In fact, the decision Mark was referring to is an interesting case in point. So, first of all, attempts to negotiate a multilateral investment treaty failed completely because public opinion was mobilized against it. It was being done in the OECD. Jonathan, you might even remember this better than me. Anyone who thinks you can apply a pure treasury-type mindset to this is going to make a big mistake. And I think one of the most interesting public policy issues here is around foreign investment screening. So here we had a case in which I'm not going to comment on my political opponent's decisions to turn down the Canadian Pension Board's application. I can't. It's just not appropriate for me to do so. But the danger is, what do you do if you have a yes, but formulation? If you have no but formulation in it, you're saying yes to everything, and I'm not sure our public opinion in any of our countries is, in the long run, going to tolerate that. There is an old phrase, English aristocratic phrase, full dripping with cynicism: beware of doing too much good. So, the problem is you set up an investment screening procedures like we've got, and then you get this completely unexpected decision that the previous New Zealand government made.
Which was just for context was approved by the Office of Overseas Investment.
Yeah, exactly.
And then turned down politically.
On the other hand, having an FIRB or a similar institution that allows the government to receive formal, hopefully objective advice, but leaves the decision to a politician at the end, does at least provide some basis for the argument, we've looked at this and we've considered this to be in Canada's interest or New Zealand's interest. I was skim reading that paper last night. Was it Professor Moran? Was it on strategic framework that he was suggesting? And the final conclusion in it, and I only skim read it, and what's more, I was skim reading it in French, trying to restore my French, was the key point of having such a analytical typology or framework is to allow the Canadian government actually to point out what my analysis shows, that in the vast majority of these resource cases that I've analysed, of which some references have been made to these issues today, there clearly is no cause whatsoever, no plausible, he said, ne présente aucune menace plausible, do not indicate any plausible threat whatsoever to Canadian sovereignty. So you can see, here's the duality of this issue. You set up a review process of that nature, and you give your political leaders an opportunity for saying to the public, oh no, we've had a careful look at this, but at the same time, you open up the possibility of some arbitrariness. And I don't know where the sweet spot is on this.
So just to come back to those are good comments, to come back to the yes, but situations. I mean, in Canada, there have been, since the days of FIRA, something in the nature of 16,000 Investment Canada applications. And there have been 2 rejections, only 2 rejections. One was the MDA transaction that related to one of the most powerful satellites in space that was Canadian launched. That's a separate discussion. And the other was Potash, which represented really a political grass fire. So by and large, we have been extremely welcoming of foreign capital. And I think we have a framework which is welcoming. The net benefit test has been accused of perhaps being too flexible, but it does accord the government of the day the capacity to respond to current exigencies.
Where should politics play into it? Where should the political reality, which is, not to dismiss it, it's democracy. Where should the federal government today factor in the fact that it appears that there's some plurality opposed to the next incident?
Well, I think it factors in on that slide because 76% of the people have some concerns about this, and no government, no one who puts their name on a lawn sign, as Tim says, can afford to be inattentive to that.
Can I say that's framed as precisely as it should? I think there's less issue if CNOC, for example, I'll come back to this because it's topical, had bought an operating interest in the assets. what wasn't expected was to buy the whole goddamn head office. So I think if this was reframed, you might get a different outcome. Capital is required, and people understand that for development of projects. But that's a different take on it than control of the company. So.
Yeah, I think that Jim's point is we have to be aware of public opinion, obviously, and we have to provide our politicians with the coverage or with the input to make the right decisions. And these kind of polling numbers show that there are circumstances where the government has to say yes, but to these types of transactions. And the question is, when is the but there? I would argue that what governments have to do is continue to explain to the public the benefits of foreign investment, the need for foreign capital if you're going to grow the economy. But at the same time, I think that much like the United States and Dubai ports of Chevron Unocal, there is times when the public looks for the government to say there are times to say no, and how you define those types of transactions and where you do. And I think we're having some of those discussions right now on the CNOC next one, although I would argue that one is arguably more a preliminary match or an undermatch potentially in what could be other things. And I think it's important to get some ground rules set now before we get to the next stage.
I just add a caveat to all that. I'm going to come back to something I said before, though. When we're looking at what is the net benefit to Canada, I do think we can't be naive about it as well. And I want to remind people that Canada is an exporter of capital. And, we can take all the capital in we want, and as our current account surpluses build, if we're successful, we have to find a way to deploy that. And so to me, what's also in the interest of the country overall is putting ourselves in a position when these circumstances come about to use the leverage that it creates to ensure that Canadian exporters of capital and Canadian business more generally is afforded the same types of benefits in the recipient country that's trying to invest in Canada. And I don't think we should be naive about that. In fact, I think we should be quite strategic about that and ensure that is part of the calculus that goes into it. And is that political? I guess. I think it's strategic.
I guess I want you, and we're going to bring it out to the floor after this, but I just want you to address this one aspect, and any one of you can address it. But both China and India have stated a strategy of acquiring these strategic resources to feed their hungry nations. These are not capital investments for gain. They've literally on paper that they're acquiring the resource. As a Canadian, this is obviously oil trades on global markets. Today, this is not a problem. But one could picture a time when it could be a strategic problem. And I'd only toss that out in the same week that CSIS, in its annual review, said that we need to be paying attention to these strategic state-backed investments. Not naming China, but certainly China would be on that list.
Well, let me speak to that a little bit, because we face this going the other way. Right, we are subject to the CFIUS legislation in the United States. We're subject to Foreign Investment Review Board in Australia. We're subject to the Office of Overseas Investment in New Zealand, et cetera, et cetera, et cetera. And one of the things that sets CPPIB apart, and what we state very clearly when we're filling out those applications and making an argument, is the purpose for which we're investing that capital. And in our case, it's very clear what that purpose is. It is an investment-only mandate. We are an organization that operates at complete arm's length from the government. We're transparent in terms of the way we report. Our management is appointed by an independent board of directors, not government political appointees. And the capital that we're investing is not government money. It is, in fact, the capital of 18 million Canadian beneficiaries that's set aside for their retirement, and there's a real liability that has to be paid in the future to those beneficiaries. And so when we fill out those applications and when we go before the CFIUS panel or the Foreign Investment Review Board, We have to make that clear. And not only do we have to make that clear, we have to back it up with fact. And I think that is a perfectly logical question to be asked. And I think you should be able to answer that with fact. Now, I don't know, where one comes out on the current example, but that's a question we should be asking, and we should determine, is this an investment, or is there some different motivation behind it?
Well, I look at strategic resource in terms of food because clearly this is a strategic resource. And there are multiple dimensions to this. I mean, first of all, for reasons I haven't got time to explain, I think a lot of investment coming out of Saudi, Korea, China, and other emerging economies to invest in land in the Sudan, Latin America, and other places will turn out to be a mistake because fundamentally land is a bit like hardware versus software. The real value is not the land, it's the software or farming systems you put on the top. And I think a lot of mistakes will be made. But that's their choice. In terms of the debate in my country, of course, it's first of all, there's a fundamental distinction in our political debate between greenfields and brownfields investments. I mean, the public can understand a greenfields investment intuitively, okay? Brings jobs, nothing's going on there, let's do it. Brownfields investment are more subtle because they're about better management of existing resources. That's a harder sell. China bid to buy 12 very significant farms in New Zealand. This caused a huge public debate for the first time. And, Celine Dion had bought herself something like 3 times as much farmland. So the issue quickly got, is this a racist thing going on here? Is this New Zealanders are comfortable, in this case, sorry about the Canadian Pension Board, guys, but, comfortable with Canadian rock singers, even not the Canadian Pension Board, but uncomfortable with Chinese investors? I said this to maybe a few people in another audience yesterday. The Prime Minister and I made a conscious political decision to front foot this issue, to say, no, this has gone far enough. We will vigorously defend the OIO, the investment approval process, which eventually came up with a positive recommendation, and we will approve this. And, we thought about any wise government thinks about using political capital. Is it worth using political capital? We said yes. And in the end of the day, I think we won the debate. So I don't think it actually did cost a lot of political capital to come out and aggressively defend a non-discriminatory policy on this issue. Once we had the recommendation from the officials who look at net national benefit saying there is net national benefit.
So, Matt, you make the point that India and China have their strategic objectives. I would simply say that so do we. And I think many of us here are saying we can't be naive about that. We have to be very shrewd about this. And we need to be at the table well-armed and know exactly what we're doing. And I think as Wendy Dobson said in the last session, there is a deluge of capital prepared to come to Canada to invest, in particular in the oil sands, but in agriculture and elsewhere. But the issue at the moment is very much the oil sands. We can't develop the oil sands on the scale that we want to as a country without foreign capital. The projects on the drawing board represent over $200 billion of capital investment in the next 10 years. Can't be done without foreign capital. And capital from Asia, in particular China, is part of that equation. That's our strategic advantage. In that context, we have to be shrewd about state-owned enterprises, what they represent. No one's concerned about the ethnicity, I don't think, of the capital, but people are asking questions about whether or not the capital will behave according to market principles once it's here. And that's the reason Canada's put out a guideline on state-owned enterprises and said relevant considerations include where will your head office be? Where will you be listed on a stock exchange? Will you be listed on a stock exchange? Will you have an independent board of directors? Will you have an independent audit committee? These are all referenced as factors the Government of Canada can and should take into account.
It's in fact been noted that state-owned enterprises have a different cost of capital, so it's an unequal playing field for investors, which should be concerning to some big investors.
I think there's some amnesia here on history. You know, and I'll be provocative about this. U.S. foreign policy in the Middle East was always about big oil. What is the difference? UK foreign policy in the Middle East was always about BP. What is the difference as to what is perceived today?
It's a good question. Do we have questions in the room? Yes.
Hi, it's George Gosby from Altacorp. I'd just like to ask the panel that we might, their opinion, if we're at one of those but moments with regards to Nexen. And Murray, I think you're aware of this, that the fact that the Canadian oil and gas industry suffers a deficiency with not being able to capture world prices with regards to a number of things, largely not having a West Coast pipeline. It gives the advantage to longer-term capital and a cheaper cost of capital. It can ride that out. Are we at one of those about moments now with regards to the structural issues we have with regards to the oil and gas industry now with Nexen?
Well, I mean, Amanda's comment about a cost of capital and George, your comment about right now in Canada, we are suffering a made in Canada discount both on the export of our product and, frankly, the import of product. We're paying a premium in the eastern provinces. And a number quoted yesterday was about $20 million a day. The number I see more is about $50 million a day, or about $18 billion a year. Right now, the country is suffering as an economic cost in terms of underselling its product and overpaying on the East Coast. So George, to the extent we cannot get those market prices, our Canadian companies do trade at a discount and have less economic value creation than otherwise would have. And that is a concern in terms of state-owned enterprises. To the extent they have a lower cost of capital, they can ride things out. And I think that's one consideration that has to be put into the debate around the whole investment oil and gas business. At the same time, I come back to my premise that we do need foreign capital, that we do, as an economy, if we're going to go have substantial projects before us. Although I would point out that foreign capital can also take the context of capital supplied in the context of either equity or debt to Canadian-based companies. So much like the Canadian banks who said they've never had a problem getting capital through all their cycle, most large Canadian companies who have successful track records and have quality balance sheets have no problem getting access to foreign capital in terms of either debt or equity markets they need. So to me, it all comes back to a bit of a balance here, and how you find that balance between cost of capital, state-owned enterprises, the need for foreign capital, and making sure that we have a vibrant Canadian industry also.
Any other question out here? Yes?
William Jiang, University of Alberta. A question for Minister Groser. As you may learn now, this conference, Canada has a debate about engaging Asia, especially China. Many think tanks, Asia Pacific Foundation, having a prolonged national conversation on Asia, trying to promote the understanding. Last night, Minister Baird made it clear that Canada is going to focus on the existing deals rather than initiating any new free trade agreement. I guess that's a subtle indication or the answer to the Chinese ambassador, Canada's call for a free trade deal. But New Zealand is the only country that done it. It's a small country. If anything, you should feel insecure about it. Could you comment and give us some insight on how New Zealand feels about entering into a free trade agreement with China, and how your neighbor Australia is taking a prolonged negotiation process, and what we can learn from Canada in that dimension? Thanks.
Well, first of all, I would say that now that Canada formally will be part of the TPP, I mean, this is an Asia-Pacific play. I mean, yes, it is, as I argued in the broader room, also probably de facto way of rebooting or refreshing the NAFTA, because it involves all three NAFTA countries. But fundamentally, it's an Asia-Pacific play. So, you know, celebrate it. You're in the game. And you'll find out what the costs and the benefits and the hard and soft choices were as we negotiated. In terms of our position on this, look, I mean, maybe we'll be faced with some tough choices because, you know, there's a whole bunch of people in different parts of China who see TPP as a China containment game. in parts of the United States would actually like to be presented in that vein. But I'm sorry, and I really can speak for Australia because I've talked at length with Australian ministers on this, we're not part of this deal. We are not seeing, what I see is, the reason why people see that is because for the last, I don't know how many years, we've lived in a single hegemonic power-derived environment. And it was Great Britain until, 1915, 20, and then it became the United States. So everyone assumes it's a zero-sum game. I don't for a minute believe that's the way the world is moving to. We're moving to a multi-hegemonic base in which we have, if you like, these 4 civilization states, bigger in a sense than any conceivable country. So you've got the United States around Washington. You've got countries that could have been independent countries of major size around Beijing. The same thing about India, Uttar Pradesh being bigger than Brazil. And then you've got this grey area European civilization state, the evolving European Union. So I don't see power being any longer the province of one country. You've got to be with them or you're not with them. I'm sorry, we're not going to be anybody's meat in anybody's sandwich. We are determined to have an excellent economic relationship with China and the best possible deal we can get out of the United States and TPP.
Yes?
I wanted to ask, I don't have the timing specifically here, but the extent to which the yes but in the United States might affect the dynamic of the decision at all in Canada on Nexus. And I say that first, I want to observe, I don't know who the 24% are that think to sell assets to a state-owned enterprise that won't lose some measure of control. I don't meet those people, but the assets that Nexon has in the U.S. are not a significant percentage of their assets, but they are all public leases, government leases in the Gulf of Mexico, which the U.S. has wanted to renegotiate with the current leaseholder. And they have a zero royalty due to an error that was made. I think there's a zero chance that the U.S. government will approve the transfer of zero royalty leases to a foreign-owned enterprise. So either they deny it or there's some significant adjustments required. So assume for a minute that in the political environment in the U.S., that the U.S. just decides they're not going to permit the transfer of Nexon's assets to CINA. Does that affect the political dynamic? And then
Ambassador, you could tell your friends that if they would do that, it would save the Canadian government a heck of a lot of trouble.
I think you're back to some of the geopolitics that we heard about last night in a lot of detail. And when I say I believe that we need to be shrewd and strategic on the global chessboard of energy about the CNOOC-Nexon transaction. I think that the government will see the wisdom to approve that transaction. And I think the Canadian public can be convinced of it because I think it's in Canada's interest. And I say that for 4 reasons. One is we need the capital, as we've discussed. Secondly, we very much need a strategic partnership with China because we need a second market for our energy. Thirdly, I think if you look at the portfolio of assets inside Nexon, they are not even predominantly Canadian. There's a significant Canadian portion, but they're a pretty diverse bunch of assets. And fourthly, if you look at the overall ownership of state-owned enterprise assets in the oil sands, and specifically Chinese investment in the oil sands, it's less than 10%. And so it's not yet at the threshold where it starts to raise some of the big policy questions that Murray's alluded to and which will definitely come, but we're not there yet. And
I've seen a much higher number. Is that debatable, that 10%? I've seen 20%.
It's a hard number to quantify, but my understanding is it's in that order of magnitude. So I simply make the point that that's how I think Canada should look at its strategic interest. The United States might make a different decision, but it then puts us right back in the middle of how things play out between the United States, Canada, and China.
Jim, I think, has hit on the 4 reasons why the transaction is probably of a net benefit to Canada But I think the bigger condition is this yes, but, or the conditions that any kind of approval is granted. And I think that the question will be for CNOC is conditions put forward by the government in the transaction of Canada, are they conditions that they can live with? The same thing will be in the case of the United States, conditions that puts forward under CFIUS are the conditions they can live with. But I think even more important is those conditions the government puts forward in terms of providing guidance on future transactions, because I think that the public polls shows that there is angst among the public out there, and if governments don't respond to their public, we know the end result of that. And secondly, I believe that there are a Canadian interest in making sure that we have a strong Canadian presence in the oil sands, because it's such an immense resource for the country. And there are certain assets in the oil sands that I would argue are much more strategic for a Canadian presence than maybe the assets that Nexen has. And so I think, to me, the big decision on Nexen is going to be, yes, with these conditions, what those conditions are and how CNOC responds to them.
Paul?
Hi, it's Paul Hill from Saskatchewan. I would like to go back to a point that was made earlier, because I think there's a big difference here between foreign direct investment by way of a joint venture, and the money's going right into the development of the asset, by way of issuing a minority interest in treasury shares where the company is taking the capital, investing directly in the development of the asset, as opposed to taking over control of a company where the money is going into buying shares. That's not direct investment going into the asset. And quite likely, in most cases, then it's being financed by the banks, so the cash flow of the company then goes to paying back the debt that financed the acquisition of the shares. So now you've got the control of a company owned by a foreign interest, as opposed to capital, which we all need, going into the development of the asset. And I think that differentiation is very important in terms of what's the net benefit to Canada. So any comments on that?
Felix, you raised that point. When this deal was announced, it was actually seen, it was kind of celebrated as an achievement in its structure, a new sort of maturity, and yet maybe that is the problem, is that it's a wholesale takeover.
Buying the company actually has more governance, particularly a public company, and you even take it private around it. I would have thought that you actually, well, let me try and phrase this precisely. A concern about control of the natural resources. Buying the actual resource itself, or the operating asset itself, I think there is potentially less or a loss of control there relative to the buying the company. So, but yet, as I said, my sense is that if in fact the money was going into buying the operating asset, there would be less of a fuss than buying the company. But perversely, I think any concerns of loss of control, I actually flip the other way around.
And I would argue that the debate is broader than just the control of the resources. I think it also goes to the input on the resource development. And clearly on the oil sands, it is a great Canadian asset. You're talking the third largest resource in the world, we heard yesterday. But there is clearly in Canada a lot of focus and debate among Canadians upon the development of that resource and the associated stewardship of that development from an environmental economic perspective. That is a good debate to have. I know from personal experience the industry hears that debate and is clearly committed to do it in a responsible manner. And I think the last 2 years the industry has been much more responsive to Canadians in terms of communicating to Canadians about the asset, in terms of the economic impact, and the way that we are trying to do that in a responsible, strong stewardship manner. And I think Canadians have actually seen some of that communication. I think it has started to make a difference. My experience has been that a lot of that debate and communication with Canadians has been taken place by the Canadian companies. In other words, is that the Canadian companies, we live here, we work here, We invest here. We have boards of directors that are made up of people from across largely from across Canada, but also in the world. And so when those directors come to us from a governance matter, they're reflecting Canadian public opinion. So they're making sure that as stewards, we're doing that communication. And so that's why I think it's important, not just from a control point of view, but also from an endpoint governance development point of view, that you keep that strong Canadian window for the industry to develop. That doesn't preclude foreign investment, but I think you have to have both.
Just to respond to Paul's question, it's a difficult question, but I just think it needs to be said that the framework that the Government of Canada has put out is actually encouraging state-owned enterprises to not buy assets per se, but rather to actually come here as functioning companies, to be listed on the stock exchange, to have independent board of directors, and to operate in that way. Those are all very clear, not requirements, but guidelines under the framework that's put in place. So to some extent, CNOC has been responding to what the Government of Canada has asked for in terms of the commitments that they've made publicly.
And Jim, you're being too modest. Those proposals were introduced in October of 2007 under your leadership.
In the back there,
You're too kind.
Sorry.
Yep.
Yes, Andre Desmarais of Power Corp. One of the things that I've been trying to wrap my head around is if a company wants to buy these assets, and in this particular case it happens to be China through CNOOC, I would think that with China's interests for the long term, particularly with the wealth that we have in resources across the country, that they have to pay particular attention as to how they're going to do this. And I would think that they have to be extremely good citizens. I would think they have to pay their taxes. I would think they have to grow things. And they would have to develop this company because it's going to be watched very closely. And so, therefore, I wonder why we are making a discrepancy between one owner and another owner on this asset. Because ultimately, somebody's got to own that company, and whoever owns that company is going to have to pay Canadian taxes. They're going to have to operate within the law. They're going to have to operate that company within our law. And I don't see the interests of China in not operating it in that way. It's in their interest to be good citizens and to move on. So that's the first comment. I'd love to hear what the panel has to say about that aspect of it. But the second aspect that also I find curious is that if there was a strategic reason as to why the United States might get into a fight, as Mr. Brenner was saying, or may not get into a fight, but, not see eye to eye with China over the long term, it seems to me that if the United States gave Canada a call and said, look, we know that CNOOC owns these assets, but we really want you guys to close the tap here because we're not very pleased here. We're into a real war with these guys. Well, we'd have to make up our minds about what our interests are at that time. And my guess is that the United States would win that one in a flash. So, maybe I'm pushing this a little bit too far, but I'm trying to understand what I call this geopolitical risk also. And I'd like you guys to enlighten me about why the fact that Chinese people own this oil that is sitting in our ground, which has to operate within our laws, is this huge threat all of a sudden to the United States.
I'll make two comments. First, on your second point, I think any sense that Canada should duck this issue would be a huge mistake, even if it were given the chance to do so. This is an opportunity for us to set policy and set strategy, and we should look at this opportunity as one where we can really put our best foot forward, whichever way it comes out. And I think, thankfully, I don't think the government's taking the approach that it wants to duck this issue. We should have the type of debate that we're having here. And we should have the type of debate that the public wants us to have, and we should make a strategic decision as a country, and that's, quite frankly, the role of government. On your first point, which I think is a very important one, I think it really goes to long-term stewardship of assets. And I think we're in a world today where by and large, the public corporation is focusing on the next quarter. 90 days. That's what matters. And, you know, I see Don going in the front row, and he's heard me say this before. We should be focusing on the next quarter century and beyond. And, you know, I think the point is, in terms of who is going to be best placed to responsibly exploit these assets or any other assets, be it an airport in New Zealand or oil sands or a toll road or an operating company, I think we should be asking ourselves what type of owner will take a long-term view in terms of the responsible management of that asset. Now, I'll go back to the airport for a moment. I believe, again, publicly owned, widely held corporation. You know, I believe, rightly or wrongly, you may or may not agree, I believe that airport would be a better airport with a long-term owner that is focused on investing capital in it for the long term, developing the facilities, improving and upgrading it, because an owner that has a long-term interest, and it doesn't have to be a pension plan, but an owner that has a long-term interest can look beyond the next 90 days and say, look, we're going to invest for value creation that may accrue in years and years and years to come. And we're willing to do that because we're going to be around for years and years and years to come and not just trade out of the stock on the stock exchange. And I think we should be looking for more of those types of owners of our critical assets.
I assume Mr. Desmarais supported the Lowe's takeover of Rona. I assume that you would then also have supported the Lowe's takeover of Rona in Quebec.
I haven't looked at that one in particular. I'm more interested in this debate right here. But yes, I mean, if there's a good bid made, and people should look at that, and then people can make up their minds on what they want to do. What I'm trying to figure out here is not the Rona issue, it's more the specific issue of why it is that China would be such a bad owner for this asset when ultimately the asset is here, we set the laws, we have the taxation, we have all the aspects to control that transaction if we want to.
Yeah. I think part of it comes
just got
back
some of the
this.
problems there, and so I'm asking the panel their viewpoint on that. I'm not emitting an opinion per se.
I was going to say part of it comes back to this macro context about all these adjustments that are going on. No country descends from its position gracefully. No country ascends to its new position gracefully. So it's always going to be friction. They're going to be non-linear, and therefore they affect the psyche. And that's why we're seeing some of these fissures or some of this friction that goes on, and this will go on for some time. So underlying it are all of these shifts that are taking place and how they manifest themselves on issues like this.
Let's be clear that from my perspective, I don't think this is at all a debate about Chinese investment in the oil sands. In fact, I think that for some of the reasons Jim pointed out to having interest in alternative markets, some Chinese investment in the oil sands would be in our country's interest. I think what my view is that we have to balance in terms of what's not, so it's not just Chinese, whether it's American, Norwegian, Indian, whatever. I think that we want to make sure we have access to foreign capital, but I also think as a country we want to make sure that we maintain some Canadian presence and ownership in the oil sands. So it's about balance. And I think that's the debate the government has right now, is how to get that balance correct. And if they don't set some parameters or some balance, then we're going to be having this debate for the next 5 years, because it won't just be Nexon. It will be on and on and on. And to me, there is that the balance debate that has to take place. And it's not just China or the United States or Norway. It's about how do we maintain a Canadian presence, because I think it's good for the oil sands. I think it's good if we want to develop the assets. And coming back to Mark's question, on the oil sands, I can tell you that the companies are taking a long-term view. We're doing things together. We've created a communication strategy together. We've created now an environmental technology group working collectively. These are companies that are taking long-term decisions, working collectively, because they see this as a very long-term asset. So I think we actually are doing that and doing the right thing.
Right, and I just think we have to ask, in the new ownership, are we going to, are we putting an owner in place that is going to be a long-term steward of that asset, or have some other purpose?
Yeah.
Can I just say, I think nevertheless the direction of the gentleman's comments are entirely correct. In the long run, this will be resolved by having the right policy frameworks in place and the right regulatory frameworks in place to govern all investment, whether it's domestic, international, no matter what the source is. Now, there may be some new challenges that regulators have to think about. But, we have fly-by-night Canadians and fly-by-night New Zealanders that will screw anybody for a buck if you allow them to do it. Let's be honest about it.
Not Canadians.
Not Canadians. So I forgot, there is only one exception in the world. There are no fly-by-nighters only in one country. So, we had this debate. See, Australia owns 95% of the banking assets of New Zealanders. The other 5% were owned by proudly 100% owned New Zealand finance companies. Now, anyone who had, with practically no exception, anyone who had their pensions in those wonderful 100% owned New Zealand companies lost their life savings in 1997. And actually, thanks to the Australian banks, which have regulatory frameworks very similar to Canada's, because the best managed banks in the OECD, as far as I can work out, are Canadian and Australian, they saved our bacon, to be frank. So, there's nothing magical about your own people being, long-term wonderful people. We have to have the right regulatory frameworks in place. Now, it may be, the shift, there'll be people in this audience who remember the paranoia in the 80s over Japan. Remember, sell the Imperial Palace and you buy everything in California, lock, stock, and barrel. A completely absurd proposition, because as soon as you released even an acre of the Imperial, the bubble would have burst in the Ginza area. But nevertheless, now it's China with 3.4 trillion. So this shifts around, but fundamentally it's about having the right regulatory frameworks in place. Now, one small last point. We have, because of the nature of some state-owned enterprises, and they may not be just Chinese, they may be any other countries. We just want to be sure that they're conducting their operations in a transparent way. So we have introduced a few little tweaks in our policy structures around the issue of transparency. And when it comes up to the government to approve, we're looking at things like, will there be New Zealand resident-based directors on this company? What will the reporting functions be, so that we can, with our generally robust regulatory frameworks, at least ensure they're going to work. So there are some issues, but I think fundamentally the point the gentleman made over in the back is absolutely the right direction.
I've just been given the 5-minute warning. So, Bill, let's see how far we get.
This is exactly on topic. In regard to the potash decision, Bill Robson, City Howe Institute, in regard to the potash decision, one view I heard from a provincial level official was that ownership was an issue for them because they couldn't actually enforce the regulations they had in place. And so they defaulted to focusing on the owner rather than what otherwise sounds like a very good formula, and one that I often say myself, which is that we're going to apply the rules even-handedly. So is it possible that defects in what we're trying to do on the regulatory front, whether it's with regard to transfer pricing or anything else, might drive us to ownership as the thing that we focus on? Because if so, the CNOC thing wouldn't pass muster.
Well, your question and Andre's question, I think, are interrelated. And I personally think the debate is a healthy one. I think it's only just starting. I think maybe some of the investors to Canada are surprised what the debate looks like as it unfurls with 35 million flowers blooming and individual opinions. But that's just the nature of the way it's going to be. The Canadian public, I formed a view in my time in public life that the public gets it 100 times out of 100. And the underlying concern, I think, relates to two factors. One is they know that in this lottery that we won as Canadians, the oil sands are an extremely important resource. They get that. And so they want to be sure that there is robust Canadian investment in the oil sands. Secondly, they know that state-owned enterprises amalgamate the power of the state with the power of capitalism, and therefore they are, by definition, somewhat different than CNRL or Nexen or any other company. And so I think the public is simply saying, okay, what's the plan? Somebody just tell us how this is going to work, what the rules are, and so that we can be satisfied that those two factors are balanced. And I think it'll be a healthy debate.
Last word here.
Yes, I just had a comment. We've heard throughout the last 2 days that Canada has the resources the world wants. We need to pivot to diversify our trade with other countries, and we need capital to do that. And there's a vast source of capital in some of these new countries that are not perhaps where much of the foreign direct investment came in the past. When you look at these three things, we have the resources, we need to pivot to more diversity, and we need the capital. It would seem to me that it should be a resounding yes, and instead of having a debate from PhD to Lowe's to Nexen on when we exercise the button, that we should have the debate on what's the net benefits and what shape and form does it take, what do we need to say yes without second-guessing ourselves from deal to deal. I'd be curious with the panel to think in terms of shifting that, because lots of the debate at the moment is going from one deal to the other on whether this one is a little too Chinese, a little too SOE, a little too strategic, a little too but, as opposed to what is it that we want.
Felix, there is kind of a sort of a secret sauce in the net benefit test. I mean, we don't really know, there's not great clarity on it. From an investor's point of view, how does that feel?
If I was to put the investor hat on, I'd say clarity would be desirable. If I was to put on the government's hat on, I would say non-clarity or lesser clarity would be desirable, because it gives you, a significant amount of wiggle room. So the reality is, I don't think we're going to get absolute clarity, and that the government would and should reserve some wiggle room for itself. But to respond to the comment that's made, I think you're right. Diversification of the market, pivoting and all that, I don't think there's any debate or disagreement about it, but it seems to center on the how. How are we going to do this? And, most of yesterday was talking about these are the things we should do. I think we need to focus a lot more intensely and a lot more detail on the how, which is where some of this is leading, but it's obviously incomplete. As I said, my own view is, I think, state-owned enterprises have a responsibility to articulate, and be more transparent about what they do. So if part of the concern is what are these entities and what they're up to, then they too need to take on some accountability to kind of articulate what they are about. But at the end of the day, we have to find out how, because the reality is that these things exist, they're not going away, and we'll have to find a way to accommodate all of these different entities and different organizations.
All right. On that note,
One more question.
One more question?
It hasn't come up yet. Leverage. Should we be permitting a state-owned company from a country to take over something in Canada when we cannot reciprocate and go back and take over a company in China? Is there a leverage issue here, and should that be part of the Investment Canada decision-making process?
Thank you for making it a really simple question, Paul. Does anybody want to take a quick run?
Yeah, I'm currently in negotiations with God over this issue, but I think the idea of us forcing reciprocity on China is probably going to take a bit of time.
Look, I'd say this is a remarkable opportunity for Canada. We're at a conference here about Canada in the Pacific Century, and we're presented through a potential transaction that's essentially landed in our laps, to not only have the debate, but to make some important decisions around how we're going to deal with this issue and issues going forward. And my view is, I don't know if leverage is the right word, but being strategic about it, thinking about the broader net benefit to all aspects of Canadian economic activity is important. And so, I don't know if leverage is the right word, because it's a pretty big place to try and lever. But certainly, I think we have really an opportunity to be strategic. People are watching, and I think this is a wonderful position for Canada to be in.
All right. On that nicely optimistic note, please join me in thanking our esteemed panelists, Mark Wiseman, Felix P, Murray Edwards, Jim Prentice, Tim Groser. Thank you all.